Quick question. If interest rates change tomorrow, would it affect your life this week? Your rent? Your job prospects? Your debt payments? The answer is yes, because interest rates are the invisible force that controls the price of money itself. An interest rate is simple. It's what you pay to borrow money, or what you earn when you save it. When rates go up, borrowing gets expensive and saving pays better. When rates drop, borrowing gets cheap, but your savings account barely grows. Think of it like the price of gas. When gas prices rise, everything that needs fuel costs more. Interest rates work the same way. They change the cost of everything that runs on credit. So who decides what rates should be? In most countries, a central bank sets the baseline rate that influences everything else. In the United States, that's the Federal Reserve, the Fed. In Canada, it's the Bank of Canada. Europe has the European Central Bank. The UK has the Bank of England. These central banks set what's called a policy rate, a starting point. Then commercial banks use that as a foundation and adjust rates for mortgages, car loans, credit cards, and business loans based on risk and competition. Central banks don't just pick random numbers. They adjust rates like a thermostat, trying to keep the economy from overheating or freezing. They watch three big things. First, inflation. If prices are rising too fast, think groceries, rent, gas, they raise rates to cool down spending and borrowing. Second, jobs and economic growth. If unemployment is high or businesses are struggling, they lower rates to encourage borrowing, investing, and hiring. Third, financial stability. They monitor banking stress, housing bubbles, and sudden shocks like a pandemic or war. Okay, here's where it gets personal. Even if you don't have a mortgage or invest, interest rates hit your wallet in at least 6 ways. Mortgages. In Canada, many mortgages renew every few years. If rates jump, your payment can spike hundreds of dollars per month. In the US, most mortgages are fixed, so existing homeowners might be safe. But anyone buying now faces much higher monthly costs. Rent. Even renters feel the squeeze. Higher rates slow new construction and raise landlord costs, which often get passed to you as higher rent over time. Credit cards and personal loans. Credit card rates usually track broader interest rates. If the central bank raises rates, your card's APR often climbs too, making debt more expensive to carry. Pro tip: pay off high-interest debt first. Car loans and student loans. Planning to buy a car? Higher rates mean higher monthly payments or stricter approval requirements. Student loans can work similarly. Variable rate loans adjust with market rates. Your job and salary. This one surprises people. When borrowing gets expensive, companies may delay expansion, freeze hiring, or skip raises. Lower rates? They're more likely to invest and grow their teams. Your savings. The upside? When rates rise, savings accounts, GICs in Canada, or CDs in the US, finally pay something worth noticing. When rates fall, your savings barely grow. So tracking interest rates isn't about being a finance expert. It's about making smarter decisions on debt, housing, big purchases, and even career moves. If this was helpful, I'll make a part 2, what to actually do when rates rise or fall. Simple steps, zero jargon. Drop a comment. Tell me your country and whether rising rates are hitting your mortgage, rent, or debt right now. Subscribe for more simplified financial concepts. Thanks for watching.